little while since I got a video up, couple weeks, I'd imagine. Annoyingly, unfortunately. What I have been told to do though is say, I'm trying to grow the channel, need more people watching. So I've been told that you should be saying, please like and subscribe at the beginning, just to help try and grow the channel. So that'd be beautiful if you lovely people could do that. It would help massively on trying to get the channel out there and get my journey out there of trying to become a successful value investor from nothing, effectively. Not non-effectively, it is from nothing. I've self-taught, seeing whether or not I can become a successful investor. So yeah, please like and subscribe, and we're going to get straight into it. I have already looked at one business off camera because I couldn't get the required silence in the background to be able to talk about it while I was doing it. We'll go through it quickly, I think, but I've also done try to find a faster way of saying yes or no to stuff. And a while back I had this quick take spreadsheet, and I have adjusted it a bit more just to give a bit more detail on the stuff that I really care about, really like leveraged cash flow multiple against EV, simple free cash flow multiple, return on capital, tangible book value per share compared to the price. But that's more of a it's just a quick screen as a proxy for liquidation value. That's what I'm using it for. Down here, it would tell me what the company is. All I have to do is type a company in here, like AAPL. Let's just do Apple because everyone bloody knows it. There you go. So it changes it all for me, populates it all for me through Y sheets up here. And then I will just have a look at this stuff that I care about. Return on capital. Basically, these multiples, I want low multiples. Asset value is a tangible asset value is a big thing to me because my screen on TradingView only has, unfortunately, it's a very good screener, but it's only got price to book, not tangible book. So I care about the tangible assets underneath, and then against the cash flow. I press wrong bloody thing then. Where am I? I want this one open. Yeah, against the cash flow, so on reasonably low cash flow multiples. Like I said, as a proxy for liquidation value, we're using tangible book. But if it passes this loose screen, I'll go into the actual balance sheet and take it from there. So, ideally, really, I want to put another, because I got a 6-year average. I really want to put another in, because on my other spreadsheet here, my other stuff I think is, yeah, it's 3 and 7 years, so it doesn't match up with this spreadsheet, which is my main spreadsheet that I use. So I probably will put an extra year in the quick take one, just so it matches up with my averages in my main spreadsheet. I think the reason why I didn't is at the time, the dragging in of the data, which comes in down here from Y sheet. So I type in this and then, last quarter, and then last quarter -4. So you're going a year back and you're doing it on a rolling 12-month basis. And I got a funny feeling that maybe I couldn't go back any more than 6 years when I built this spreadsheet. So it's possibly changed. I'd like to go back another year, but we will, we'll keep it at this for now. The company that I was looking at was SCVL, and to be honest, in hindsight, it probably wouldn't have passed this screen. I don't actually know what drew it to me. Maybe insider buy-in. Looks like it was insider buy-in. I'll just drag it up here because I've already wrote about it. I would imagine it was insider buy-in. It would have been in March. 6th of April. 500,000 of insider buy-in, so that's what would have drawn me to it. At 16, you can just see from here it's been way higher, twice as high in 2024. So you're not talking less than 18 months ago. They invested 10 million in that. Look. Or, well, according to this, they did, right? Open Insider says that that's an open market purchase. Whether it is or not, I don't know. But, they've both got exactly the same there. Seems a bit, I don't know, suspicious to me that it's an actual open market purchase, but comes up on Open Insider's one anyway. So yeah, they've lost a lot of money because was down at 15.93 when I looked at this. Anyway, SCVL, Shoe Carnival, one of the largest family and footwear retailers in the United States. So it's a brick first on the channel retailer, so physical stores are the core business. Value focused, large store count, but facing comparable store sales pressure in recent periods. So this is the breakdown of the business. So Shoe Carnival, Shoe Station, and Rogan's. They acquired Rogan's in 2024. By category, got here non-athletics, so around about 50% of the sales. More women than men. Athletics were just under half. Accessories 1% the other. Physical stores, 90% of the merchandise is in physical stores, and e-commerce is 10%. I would imagine that's probably something that they would want to increase. I know that their business model is, brick and mortar first, but I'm sure there will be a future of looking into that, making it grow. So one of the things I didn't like was there's a huge jump in day sale payable and DSI, day sales of inventory. Have I still got it in here? Yes, I have. So we can go on this one here. Look. So they're paying payables 16 days longer than what they were before. So it is almost a form of cash flow manipulation in that they're keeping cash on the books longer than they have been previously, because that's still something that needs to be paid. So you can tell just by here that the payables have increased. We should be also in here. Where are we? Down here, payables. Huge increase in payables on the balance sheet. Sort of a giveaway generally. An inventory staying on the shelf like 40 days longer. So I didn't like that. Straight off the bat. Balance sheet. There's no long-term debt though, which is good. It's basically a no debt company. But they got a large operating lease, which is obviously counted into the debt per the change in IFRS 16, which I'm not really a huge fan of. I get that it's debt, but generally it's not the same as true debt, in that you could probably sublease a store out to stop it from losing money. You know what I mean? Like, say it goes wrong, you can sublease a store, so it's not like true debt. That debt could potentially be paid for in different ways. So I don't really like the operating lease, but 60 million in goodwill. Was there an increase in goodwill after that acquisition? A little bit, 2024. So yeah, there was 14 million after the acquisition of Rogan's. Where am I going? This one here. I'll figure out where I'm going. So return on deployed capital, 13%. One thing I've done on my new spreadsheet, now I don't know if this is entirely correct. This is from Grok, and I got to be honest, I'm probably more pro Grok these days than I am ChatGPT. For this sort of thing, I just feel like Grok's a bit more reliable, but this one here is saying the return on capital was 7.82%. This is slightly differently calculated though. The one on my, it's all ballpark figures, right? But this one is Lee Lu's calculation. This one's Joel Greenblatts' calculation, hence the JG Rock. But this is how Lilu does it in Bruce Greenwald's Columbia lecture that he did in the early 2000s. This is taken from Joel Greenblatt's magic formula. They're very, very similar in how they're calculated, but obviously it's done quite a difference here compared to one to the other. Generally, the difference isn't so big. What I did on my new quick take spreadsheet, I can look at it and go, oh yeah, 7.8% return on capital. What is the typical ROC for this sector? So pre-tax ROC EBIT. So a good, typical average would be, let's have a look, what are we going to be under? This one, I don't know, is it specialty retail? I had to figure out which one it comes under, actually. It'd be interesting to know what these put it under. I'm sure I can actually, there you go, consumer cyclical, consumer staple. I don't know, this is the problem. See, between these, but then the ROC is not, particularly different. So according to this, the return on capital for SCVL is not great. Now, I don't know how accurate this is. This is taken straight from Grok. I asked Grok, if you could give me per sector what the average. I'd like it broken down a bit more than this, to be honest. I think it's very vague. There could be certain things in here that push this average way up compared to others, The only way, I suppose, to check that would be to do true peer analysis, which I have put some peers in here, so to compare against. One thing I did like, though, 35% insider ownership on the Def 14A, so that's pretty good. I like that high insider ownership, but didn't like the jump in payables, didn't like the length of time it was taking for inventory to come off. I didn't think that this was too high, especially compared to this, but I don't know. It's got a very big revolver, 100 million revolver, backed only by their shoes. Very manageable rules, basically zero interest cost because they're not using it. Interest coverage ratio, according to the covenant as well, must stay at least 3. 3 to 1, can't go below 1. Their earnings must be at least 3 times bigger than the interest to pay on the debt. They can borrow 20 million additional debt outside this credit line. Of the total liabilities, 371 million is operating lease. Without SCVL will be a net at 16.64 a share. Book value will be 38.77 a share, and price to book will be 0.41. So you've got the potential for an asset play here. What are the historic earnings? Because this was actually a couple of days ago that I looked at this. Simple free cash flow. What was the historical earnings? Where are we down here? This one here. So higher, much higher than what? Post-COVID, that's COVID year, so it went bad. Huge jump up here, mind. But yeah, certainly higher, but then historical average is quite lumpy. That's net income, so simple free cash flow stories here. EBIT as well. Ain't too bad, I suppose, compared to historical. The simple free cash flows dropped massively. I wonder what caused that. Operating income, net income hasn't really dropped. I take out the stock comp because I think stock comp is a cost. I mean, you have got almost 30 million difference there to there, and you have got it there as well. So where did that come from? The net income there, 30 million. We got a huge difference in revenues, like 50 million in cost of it's only 15 million by the time it gets down to here. They cut costs huge by about 50 million. It's literally just in the costs and expenses, look, by the look of it. Anyway, I said what am I doing wrong again? Potentially got an asset play there if you're willing to overlook the operating lease as a non-true form of debt, like Roaring Kitty, Keith, that's Keith Gill, He spoke about it in some of his videos. He doesn't like the new classification. Michael Burry, I know, is against it as well. Like I said, because some of these leases can be, you potentially tied in, but there's ways out. Like I said, you can sublease and stuff like that. What did I say? Range among peers of usable data. So I didn't actually say what that is. It's probably free cash flow by the look of it. SCVL itself has historically traded at a similar wide band, 10 to 40 times free cash flow, depending on the year. So historically for SCVL, they've traded around 18 times EV to free cash flow. Forecast revenue is meant to be around about flat. Margins are expected to fall. As margins are expected to decline, I haven't done any real valuation. The company's going through a transition, but just doesn't seem cheap enough for me. I wasn't really keen on the cash flow aspect of it. It could be an asset play. What's the current multiple here? 20 times, 32 times against EV. So it just wasn't something that I was keen on. They've got no debt. How's enterprise value so high? Market cap plus debt minus cash. What's my calculation? Right, market cap. So F59 minus BS-B9. So what's B9? Minus cash and short-term investments. We got that all the way around. Yes, and then you add the debt, but there's no... Oh, I tell you why. It's screwed up because of this. This fucks the enterprise value up as well. I know. I remember now. It's confusing me then. I'm quite tired, to be fair, but yeah, there's no debt. But the way that White Sheets uses their data, these leases are classed as debt. So enterprise value is actually way higher than what it should be. So do I need to rethink this? I didn't even think about that actually. I've been so tired lately. Little boy keeps not really sleeping properly through the night at the moment, and it's fucking me up a bit. But I wouldn't have it any other way. I will say that. So yeah, 300 million less. More simple free cash flow. Let's have a look. Still going to be quite high, isn't it? Still like 15x. Did I say the band was average 18? It's not cheap enough for me. Well, it was 18, wasn't it? Slightly they trade around 18 times EV to free cash flow. So if we take away the 300 million from enterprise value because it's not true debt, you've still got about 20 million. You've still got 15 times. Now I suppose it is a cyclical, and you've historically had much higher free cash flows. But the forecasts aren't great, are they? The forecasts actually expect the margins to get worse and revenues to stay flat. So I don't know. It's probably something that could keep coming down. But I suppose from a cyclical play, 300 million divided by 60 is like 5 times. I mean, that's quite... I've taken from Monish Babrai that I'd like a company to pay me back within 3 years. 5 years ain't too bad. I wouldn't overlook 5 years, but I don't know. Certainly want to keep an eye on. I'm going to find it on, because I don't think I found it through here. We can see whether or not it's come up in my thing. No, it hasn't, because it's not meeting any of my metrics, but I might... Oh, it's already there. I am keeping an eye on it. Yeah, all right. I am keeping an eye on it. So, yeah, I don't know. Like, it's not cheap enough for me at the moment. But you've got a potential asset play there, and cyclically, it could be much cheaper on EV to free cash flow. What is it? SCVL. Yeah, it's looking like roadkill at the moment. I've actually put a alert on it. Look down here, around about $10 a share. Because if it breaks through this, level, technically, I would say it's coming down to here at least, potentially coming all the way down to here. So I don't rely on technicals, but there's definitely something to it. You can't say there's nothing to it. Look, when I think it's probably become a self-fulfilling prophecy type thing. In that everyone's like, oh, it peaked there last time, and then, just by what is 60% in that range there. I would certainly be interested in it if it starts coming down to here in this area. I would, which is why obviously I've set an alert on it, but at the moment, not cheap enough. There are circumstances under which it could be cheap enough, though. So yeah, that's where I was with SCVL. I think someone else was. What was he? Strong buy. Not doing very good with that at the moment, but yeah. That's a Justin Diabriolo, whatever. Where is it down there? He was involved in GameStop. I follow him on Twitter. I think it's Domo Capital. I think it is. Commenting on a lot of Raw and Kitty's live streams. Yeah. No comment on CEO departure. Isn't it a bit odd? What does it mean? One banner strategy was all idea and cancelled. Or yeah. So yeah. For me, no, not at the moment, but definitely one to keep an eye on. Go off on a little bit of a tangent here. Michael Burry recently did an interview on, I say recently, within the last few months, first interview he's done in a long time, and he was on Michael Lewis's podcast, the man that wrote The Big Short, Moneyball, and all sorts of stuff. He was on the podcast, and I found it quite interesting what he was saying, in that he's not, because at the moment this screen here is the US. You can see up here that we're in the US, and it needs to be its primary listing as well, which is I think what the crown means. But he was saying that he's not very keen on the US markets at the moment, and his belief was that around 90, I think he said 90% of the money in US markets is managed passively, in index funds and stuff like that. And now all these funds, if a stock drops a certain amount, they've got to sell a certain percentage of it, because that's their risk parameter. And he was of the opinion that if you have a downturn, the whole US market could go down, because all of these funds, 90% of the money is in these funds. They're all going to have these risk parameters that say, oh no, you got to sell because a stock has declined a certain amount, and then everybody at the same time starts selling. And I just found it quite interesting, because I don't think he's staying away. Well, he is staying away. He is staying away from US stocks by the sound of it, but not in like, oh, I'm not going to touch them at all way, but in that there is an inherent risk now in the US markets because of this 90% passively managed money in all these funds. I think they were saying, and Michael Lewis was agreeing, was saying that the US might be an outlier in that there's a lot more actively managed money in other countries. It's just where the US is at the moment. So, I don't know. It could certainly be interesting if that is the case. My reason for looking in the US is just that the ability to find the data is miles better than anywhere else. I wish, strongly, that the UK had an SEC type website where you could just go and search for everything, but they don't. They got Somerset House that you can find filings on, but fuck me, is that a ball ache trying to find all that shit. the SEC is just easy website, brilliant website. So that's one of the reasons why I've been doing the US, and generally as well is that the audits on the financials are a bit, I say safer, but then obviously in 2007, 2008, it was all dog shit. Nobody knew what they were fucking auditing, and the ratings agencies, all that sort of shit. So, you know, it's not infallible, but it certainly helps compared to, you know, investing in something in the middle of the ass end of nowhere and nobody's audited it, you know. Moni's Propriet's quite big in Turkey. Like some of his biggest, I think his biggest investment ever was in Turkey, and I'm sure he says he's always looking to invest in Turkey, but you just got to be very aware that you might be investing in stuff that is not on the level of the documents that they're putting out. So that's generally why I stay in the US. But if what Michael Burry is saying is true, then you know you're gonna have to be a lot more savvy on that, because obviously the goal is to preserve capital at the very least. You know, number one rule, don't lose money. Number two rule, don't forget rule number one. So yeah. Anyway, gone off on a tangent there, a bit of fucking waffling. Close that one down. So yeah, the only problem is if I'm doing this quick take spreadsheet, you're not gonna see it. I tell you what fucks me off as well at the moment is every time I drag a document off a screen, because I got a free screen set up here, but every time I drag it off a screen and drag it into okay, it changes the fucking size of it to a stupidly small. But what I'm going to try to do is, obviously I've got my screen here. I can have return on tangible assets if it shows up. So I can't get return on deployed capital, which is why I've done this. And you can get tangible book value per share and all that. So, but yeah, I want it all in one place that I can see very quickly and just go, right, fuck it, let's go. And that's what I'm going to start doing now, actually. I don't like investing in this sort of thing as a fund. So it's not really the sort of thing I'm interested in. Another fund, not interested in that. Fixed income markets. I mean, honestly, I'm probably not interested in that as well, but we'll have a look. I'm not one of these that would be like, no, I'm not investing in any financial stocks. But it's rare. It's rare. I said in one of my videos a while back, was it First Bank shares or something? I fucking missed out on that. Very keen to invest in it, and then by the time I made up my mind, a bloody insider bought a shit ton of the stock, and it'd gone way up, and I was like, I ain't buying it at that price. But so yeah, Kohl, COHN. Oh, just drag it in here. So EV to EBIT multiple is 4.5, so free cash flow is 11, but that's not bad. What do they do? Publicly owned investment manager, primary provides services to individuals. Pardon me. Fixed income portfolio, so I'm probably not interested in this either. If it's a money manager, firm is formerly known as, yeah, funds and CDOs for his clients. I'm not fucking interested in that. So that's another one out the way. Another trust, not interested. Another fund, not interested. DXC, I think I've looked at before, which is why it's got light blue next to it. Red is like a fuck no. Don't even bother looking at it again. I am going to. This is the first time I'm doing it. So dark blue is keep an eye on it. Green is I'm actively trading it. Light blue is I've recently looked at this, and every quarter I will probably change this to a different colour. So I'll be like, okay, then I would know that the last time that I looked at it was, 3 months ago, 6 months ago. You know what I mean? So that's where I'm going with that. DXC, I'm sure I've done a video on this one. Wasn't interested in it. Let's just bring this up and see why. That's interesting. 7 times multiple on EBIT, but historically averaged 2. ROC is 12%, which is not bad. Simple free cash flow return on capital is 20%. Not bad. Tangible book value there, that's why. I might need to add a multiple to this actually, because I don't want to buy anything generally anymore at about 1.3. Price to tangible book of 1.3. So I might put a price to tangible book multiple on this as well, just so I can see that. But for now, no. Just because the downside protection is so far away from the price. I don't want that. I want downside protection. So what's GLO? Global Opportunities Fund, not interested in that. Comcast. I've looked at Comcast recently. I did it in my, maybe my last video. I'm sure it was my last video. If I go in my tracker here, when did I do Comcast last? See, there you go. I did, yeah, I've done it. It was at 28.7 then. It's gone down since then. What was my... Not seeing anything currently to go deeper. Downside protection is potentially a problem due to negative tangible assets. Free cash flow is very consistent, as is free cash flow margin. Historically trades around 10 times EV. Is currently there now. 20 times div. Also give current share price. Not seeing any real upside. Likely fairly valued. Right. Moving on from that one then. AMC, I've looked at a while back. Over half of assets are goodwill, mainly intangibles, which crushes tangible book value. But then saying that, look, according to this, tangible book value is like trading at 50% of it. When was the last time? I must have looked at it recently because it's got a light blue. So we'll have a look in the tracker. Control F. AMCX. What did I come up with? Yeah, I have looked at it when I look at that in March. Declining cable subscribers, heavy competition in streaming. Who's more global streamers, but larger niche cable networks, focus on strong franchises. Is this one? It still owns Walking Dead, but haven't really had a hit show since, and the fanfare around The Walking Dead is not what it once was, as the show is now older. MC was a distribution channel for Breaking Bad, but is now owned by Sony. That is now owned by Sony, and they no longer have an affiliation with the show. So, what was my thing? Declining, potential for declining user base. Large amount of debt, 250 million free cash flow plus 500 million cash. Still seems unlikely they'd afford maturity, as 250 million free cash flow isn't available to spend on debt, isn't all available. Revs have dropped by 700 million in 3 years. 572 a share, average 527 a share, free cash flow 7 times free cash flow to EV. Not done, but to keep an eye on. Okay, so why if I put it on that colour then, if I want to keep an eye on it? There we go. AMCX, let's just have a look, put it and smack it in here. Just doing it off screen a minute. Drag it up and show you the results. So this is good. I like this. Do not like this at all. So this is going to be probably a no for me off the bat. I needed to have downside protection, but downside protection can come from cash flows just being so fucking good that, you know, it doesn't matter. It always matters, right? But if the cash flows are so good, the debt is seemingly not a problem, then I would still invest in it. Pardon me. Currently 6 times. I've got a funny feeling the debt maturity was an issue for me, which is why I've got it up here. Look. Oh yeah, look at that, 2029. billion, 1.2 billion in 2029. The 870 mile has just been tendered for refinance and maturity back to 2032. Coupon at 10.5%. Front end debt loading has been reduced because of this, so that won't be out in 2029. That'll be out here. Oh. Yeah, the debt's a problem. I remember the debt being a problem. KSS, what's this? I'm sure I talked about this one already. Kohls. I have talked about this. This will be another one, annoyingly, I'd imagine, that has a high operating lease expense. What's it? KSS. Let's see what it comes up with. It's another one that I've looked at. I can't remember though. That's the problem when I'm not keeping my head in the game enough. Ooh. Okay. That's interesting. That's trading at 1/3 of tangible book, apparently. 14 times multiple, though, is not great. Simple free cash flow, there's only 6. I have got the market cap multiples, but I don't really care about the market cap multiples so much because you can't ignore debt. You just can't. You can't ignore it. It's all very well saying it's got a low multiple, but if you're not taking into account the debt, then I think you're in for a fall. In for a fall yourself, not you are a fool, or you could be both. This is interesting though, isn't it? There's obviously a hell of a lot of buyers around it. Almost 300, not that you would cap, nobody cap, well they do, I guess, but the chances of you catching froth to peak is so fucking slim. Something here, isn't there? What's the news then? Trade up, what you need to know. Omnichannel investments reverse the sales decline. Can. Okay. Interesting. Where have I got the revenues on here? ESS revenues, yes I have. Oh, they have declined. Look. 19, 18, 17, 16, 15. Operating income's actually up though, despite the simple free cash flow is up massively as well. What's happened there? That can't be right. Something fishy's gone on there, isn't it? Surely. Either that or the data's wrong. Go from simple free cash flow of 182 million to a billion more. SEC, KSS. Oh, we've just released a proxy statement to see who owns what. Have a look quickly. I do. Sorry, document. Roll it. You doing that or not? No? What's up there? Fucking idiot. There we go. Not even looking in the right place. Oh dear, 1.5%. It's not great, is it? Not great. Okay. Let's see if we can find the... What's going on here? Off of that. 10k. Ah, 10k. Net cash provided by operating activities. Merchandise and inventory. Oh, they're not paying inventory. They're not paying accounts payable. Well, they've grown. Let's have a look at the balance sheet. Accounts payable, yeah, grown. So day sales are payable will be up. Oh, alright, here we go. Where's inventory? Merchandise inventory's down slightly. Not the end, not massive. So what's caused this huge increase? What's going on here? 200 million swing in inventories, 250 million swing in merchandise. So payables was the first one, and then the second was inventories. It's literally all in working capital, is it? Has to be share-based compensation is quite high, I don't know that. Deferred income taxes, impairment, non-cash operating expense. It looks like it's all in the working capital. Not all, but majoritively in the working capital. Acquisition of PP&E, proxy for maintenance capex, down year on year there. Look. Proceeds from issuance of debt, so they issued more debt. 357 million in debt. Long-term debt, yeah, there you go, it's gone up 300 million. I know, just under 300 million according to that. They must have paid some off as well then. Okay. 40 minutes we've been going. I might pause it here for a minute. We'll come back to this one in a second. You're not going to notice any difference. It's just going to flick over in a second. Alright, I've dragged Kohl's into the spreadsheet a minute. Croc's being a bit slow though. It's not blooming fulfilling my request, annoyingly. Zero long-term, current portion of long-term debt, but there is 1.4 billion long-term debt there, so finance lease obligations, so that's the same again. It's very similar to long-term debt, so there's definitely a lot. Maturity, here we go. Outstanding millions, yeah. So nothing until 2029, okay. Okay. Then 360 million, 425. There's a lot coming. Okay. Oh, it is working now. It's a bit slow tonight, unfortunately. It could be because I'm bloody recording the video at the same time. I don't know. Not normally had that problem with it. What's the cash on the books? 600 million. Free cash flow last year. This. I want to get the working capital analysis up tonight to see. I don't want to cut away from this fucking thing though, in case it stops working again. Something. No, okay. No, come on. So we can drag it up over the top and hope it doesn't change the function of what that's doing. Yeah, payables is up. Although inventory's down and they're collecting cash faster. So paying off payables slower, but I mean, it has been higher. That's post-COVID thing, that expanding, bringing it back down and taking it back up again. Not, you know. There's definitely 130 million difference there. On simple free cash flow. $11 a share was 137. Was it? Was my data right here? 152 million last year. Oh, here we go. Alright, we've got that up now. No, it would have been about 152 million last year, look. Net income was awful last year. What caused that? Was that a one-off thing? Must have been, because revenue was 16 billion. Depreciation, operating income, impairment 76. So we've got impairment this year as well. It's not the end of the world. Net income 109, yeah, 109,272. Costs have come down in every area actually. Look, cost of goods sold and SG&A come down significantly. gain on legal settlements, they lost money on that. But operating income is still way up despite this, look. So 400 million in goods sold, and then another 300 million there, so there's a 700 million swing. Okay. What's the inventory's done then year on year? They have decreased. What's historical inventory levels? There. 2 billion, 2.7, 2.8, 3 billion, 2.5, 3.5, 3 billion. So they are below historical levels, aren't they? Been a few years like it. And they've ramped up again afterwards. Okay. What I really want to do. How much did the cash position increase? A lot, 500 million. Any of that come from debt? Proceeds from issuance of debt, 357 million, so yes. Okay. Omnichannel retailer. What do they do? Oh, all sorts of stuff today. I've heard of Kohl's, but store format. Most stores 80% are in strip centers, freestanding locations. 1,153 stores, totaling 81 million square feet. Customers can buy online, pick up in store, partnerships and add-ons. Sephora. Revenue breakdowns. 95% nets of total revenue. Merchandise, other revenue, primarily from credit cards. Okay. Category women's is the biggest. Accessories, and men's homes. What? It's okay. I mean, we've got shops like this in the UK. Is it a clothes shop then, is it? Sells a mishmash of everything. Okay. Clothing, shoes, toys, home decor, appliances. Okay, no. Broad spectrum then. Private property, private proprietary brands. 30 to 31%. Geography, 100% focused in the US. Yeah, I thought it would be. Okay. There's been a bloody AI to do it for us. There's been a huge increase in OCF. It looks mainly to have come from the working capital section. Can you break this down? It's going to take a little while, but I mean, it's not all from it because you've got 170 million increase in net income to start off with. I'd like to know what the finance leases are, though. Notes, leases, operating finance leases. Finance lease, property, plant and equipment. Terms and conditions are on that. We have to open up the proper 10K, I think. Yes, you're correct. Operating cash flow surged dramatically. It rose from 648 million. While higher net income has contributed to the overwhelming driver, was a massive positive swing in changes to operating assets and liabilities. This section flipped. 500 million swing explains the bulk of it. Here is a breakdown. Non-cash adjustments, share-based comp. Changes in assets, merchandise and inventories, yep, 200. Long-term accounts payable, 200. Wide huge current capital swing. Kohl's MD&A earn material explicitly highlight tighter inventory discipline, improve working capital management as primary reason. This is the only thing though, like, is it a one-off or is it improved working capital management? You know, inventory fell 7% year over year, so deliberate shift from a modest 2% increase, lower inventory levels, reduced markdown risk, supported gross margin expansion, freed up significant cash. Was there gross? I didn't even notice that. I should do, because that's one of the first things I like to look at. There was gross margin expansion. It's actually higher than what it's been post-COVID. That's pretty good. SG&A margin's gone up though. Simple free cash flow margin is higher. I haven't even looked at the margins. That shows you how tired I am. I generally do like looking at the margins to see which way things are going. Are they 3-year averages on mine as well? Yes, they are. 3-year averages. Okay. It just smooths out one-off years. Accounts payable rose. This reflects better timing of vendor payments for extended terms, providing another major cash inflow. Yeah. Is it better timing? This is the one I don't like generally if it increases a lot. A modest improvement. The offset were relatively consistent or slightly negative. Broader context, higher net income, one-time gain from a credit card, interchange lawsuit settlement, also helped with OCS, so the cash impact depends on when it was received accrued. One-time gain. Okay. Why was it taken out then? Okay, it doesn't matter. Not primarily from higher sales profitability alone, it's a classic retail story of aggressive inventory reduction, payables optimization, exactly the working capital improvements you notice. This left Kohl's much stronger balance sheet. Okay, I want to look at the leases. Finance leases. Because they're huge. Finance leases are huge. Operating leases, finance leases, total lease payments. They have a very high amount of finance leases. Can you explain why this is and what it consists of? I mean, we're looking at it here, but we got a bit. Oh, we were looking down here, weren't we? Where was it? Operating finance leases. Also, it's in this section here anyway. Just yawning my head off screen. It's one of the reasons why I haven't got a camera at the moment as well. It's not really, but I do eventually want to put a camera on, but I eventually see this as being a live streaming channel. I just got to make it to that point. Hopefully one day I will. Right, anyway, where were we? Finance leasing, finance and obligations. Okay. Does carry material balance, finance leases, finance obligations. This is shown separately on balance sheet from operating leases, while not very high relative to the company's overall billing. In total lease liabilities are compared to other large. It's also capitalised long-term store leases, notable line that reflects the economics of Kohl's. These are leases effectively transfer substantially all risk and rewards of ownership. Classification is triggered if the lease term is a major part of the remaining economic life of the asset. Present value of payments equals or succeeds. Fair value for Kohl's, these are predominantly store leases where management's judgment based on leads us to classification. Amortization is recorded as depreciation. Financing obligations. These are legacy category primarily historically failed sale leaseback transactions that do not qualify. They're presented on the balance sheet as one finance leases, not finance obligations. After subtracting interest, these reconcile to the recognised. Total, here we go. 4 point. Cash flow treatment differs from operating leases. Principal payment repayments go through finance activities. Interest is in operating activities. Why not? Why any amount is material very high relative to some peers. Large physical footprint, hundreds of stores are leased rather than owned, so long-term real estate commitments are unavoidable. Many leases were structured decades ago in ways that now classify as finance or financing obligations. Since 2019, virtually all leases appear on the balance sheet. Kohl's installed 4 shops in virtually all stores. These major leasehold improvements, remeasurements and reset many leases. Year-over-year trend. In short, high finance lease balance structure or Kohl's leased store model. It does not represent new debt like borrowing, but rather capitalize present value of long-term store rents. Management highlights an adjusted leverage view that uses short contractual payment periods rather than the gap 18 years. Okay. For Kohl's specifically, how do these finance leases differ from operating leases? Owning the asset and recognizing interest amortization. So they're trying to buy the asset, is that what we're saying? No, I don't know. That's what we're saying. We'll let Grok tell us what we're saying. Because I'm still not... I'm new to all of this, so this might sound dumb, but I'm still not overly up together on what the difference between a finance and an operating lease is. The difference between finance leases and operating leases stem directly from lease account rules. Both types arise overwhelmingly from the company 751. But the classification depends on management's judgment about lease term, incremental borrowing rate, and fair market value of the underlying assets. How Kohl determines counting lease terms includes non-cancelable period plus a renewal option that are reasonably certain of being exercised. This is triggered especially when Kohl has made significant leasehold improvements that would exceed the initial renew term, and the store's cash flow performance remains strong. So why operating and finance leases show gap. Incremental borrowing rate used to discount payments, fair market. If the lease meets any finance lease bright line tests, it's classified as otherwise. Okay, key differences in presentation. Here's how the two categories are treated. Operating leases. Okay. Long-term store leases for Kohl's. In contrast, are plain vanilla store leases that do not meet those tests. Long-term store leases for Kohl's significant investments make renewal periods reasonably certain, pushing many leases over the legacy finance and obligations. Historical sale leaseback deals that never qualified. Only finance leases result in depreciation plus interest. Kohl's management notes that while explain the difference between finance and operating in simpler terms, as I am struggling to wrap my head around the difference when they are both to do with leasing stores. Learning as we go, and that's the whole point of this channel, right? Is that we can learn together. So might as well ask the stupid questions, and there may be people that stumble across this video that do know what they're on about and think that I'm a moron, but they're probably right. Right, let's see. Come on, pop it up, pop it up, pop it up. Because this is a huge problem, isn't it? I think, really. If we're looking at... There's a huge difference between multiples here. And it's all to do with the debt. cash a share is 106, so okay. Right. Think of both finance leases and operating leases or simply rent stores from a landlord. The real world deal is almost identical for hundreds of cars. The difference is purely how the accounts are required to record it. Does this lease feel more like a short-term rent, or does it feel more like Kohl's is basically owning the long-term right to the use? Operating lease equals renting an apartment month to month or for a few years. You get used to it, which clearly belongs to leasing a car to 5 to 7 years. The expectation you'll keep driving it almost the whole life of the car. It feels more like you own it. Yeah. Kohl's typically store leases 20-25 years plus lots of 5-year renewal options, but the accountants look at extra factors. As Kohl's poured a lot of money into the big upgrades, is the store making good money and likely to stay open for decades? If the answer is yes, the renewal options are judged reasonably certain to be used. That makes the total expected lease term very long. That tips the lease into the finance bucket for many stores. Okay, if it doesn't quite meet that test, it stays an operating lease. That's why Kohl's has roughly half its stores. Right. One single straight line rate expense, split depreciation. Okay, interest expense. Operating leases make the income statement smoother and simpler. One rent line make the income statement a bit more front-loaded, higher total expenses early on because interest is higher at the beginning. The cash cost actually pays the landlord is the same either way. The classification is just an accounting rule. Okay, so from a debt perspective, how should I treat this? As operating leases are a debt, but they are not an absolute certainty, as if things don't work out, generally these assets can be subleased in order to not lose too much money. See what they come up with. The only thing with Grok is how fast it takes to come back with an answer, but I also find that their answers are far more intelligent, recently at least, than ChatGPT. I was ChatGPT all the way until they brought out, this new ChatGPT 5 or whatever. Wasn't so keen on what it was doing then. So far I tried Grok, and I've just found that Grok's depth of intelligence of the answers tends to be better and more accurate as well. From a debt perspective, you should both Kohl's operating lease and finance is very real debt-like obligation with some important caveats that make them less rigid than traditional borrowed money. Why they're debt-like? You must pay the rent every month, yet, or the landlord can evict you, sue for damages. Balance sheet numbers already show the present value of those operating payments. Analysts and credit raters always add the full lease. Why they're not an absolute certainty like traditional debt. You're right, there's flexibility traditional debt doesn't have. Must you pay forever? Yes, until majority. No, you can close the store. How do I pop that out? Okay, just going to have to go across. Early, almost never with huge penalties. Yes, Kohl's has done it. 24 stores closed early. Subleasing allowed, not a traditional debt. Usually, yes, with landlord consent, you can try to find a new tenant to cover some of all of your rent. Negotiation. Kohl's real-world experience shows this flexibility in action. When they close down performing stores, they negotiate lease terminations, sometimes see cash proceeds recorded. They do not report any meaningful sublease income, so subleasing isn't a huge reliable safety valve right now, but the option exists in the future. Kohl's management highlights that the gap lease liability looks bigger than it feels in real life because gap lease term 18 years includes renewal options. Contractual non-cancelable term equals only 4 years. In their Q4 2025 earnings presentation, they show two leverage numbers, unadjusted 4 times, adjusted contractual 4-year payments only. Okay, they're basically saying yes, the accountant makes it look like it's 5.2 billion debt, but the cash are actually locked in for the next few years, close to half that. That's interesting, isn't it? Because I'd imagine the debt is one of the big things that put people off of this. How you should treat it for analysis. Conservative view, what most analysts add the full 5.2. Coles management, treat and operate leases, outlet finance leases, both are real obligations. Coles management, use short contractual payments and 2.1. Sublease and termination reality check is real. Mitigant but not guaranteed. In a bad retail environment, it can be expensive or impossible to find a subtenant. Yeah, I get that. Coles past closure show they can usually limit. In short, yes, operating leases are dead like no, they are not ironclad forever. Coles has proven it can shrink its footprint, negotiate its way out some obligations when needed. Okay. Michael Burry and Keith Gill have both stated dislike of the IFRS 16 classification of debt for the stated reason that it can be not of debt as leases, isn't it? For leases for state reason that it can be worked around if needed. How would that relate to this, as I fall into the same camp? See what it comes up with. I'm going to leave this video here afterwards as well. We've probably gone over an hour, I think. I can't remember how long the first part was before I... Yes, you're in exactly the same camp as the view Burry and Gill express. They criticise forces leases on the balance sheet in a way that makes them look like rigid and inescapable debt, when in practice companies can often renegotiate, sublease, terminate, or otherwise work around them. What's designed to stop companies from keeping leases off balance? It requires almost all leases to be recorded. Critics in the camp argue it's misleading loans. You can often exit early, sublease a space, negotiate lower rents, count on therefore overstates a true economic burden and makes leverage. Burry and Gill highlight this kind of accounting rigidity in various contexts. So idea that gap IFRS can turn flexible operating commitments into something that looks like unbreakable debt on paper. Kohl's textbook example exactly what they're talking about on paper. It costs $5.2 billion total lease liabilities. It looks like a huge slab of debt sitting right next to its $1.4 billion of actual borrowed debt. In reality, the workaround flexibility mentioned most of these store leases. Kohl's has already proven it can shrink its footprint. It closed 24 stores and often did so with known cash lease gains or limited costs. Subleasing is allowed in most leases, though Kohl's hasn't relied on it heavily. Gap lease term is inflated 18 years because of the Sephora build-outs. Management now assumes renewals are reasonably certain, but the contractual non-cancelable period is only 4 years. That's why Kohl's itself publishes an unadjusted leverage metric of 2.1. If you fall into the Burry camp, you would not treat the 5% as rock-solid debt. You'd view the operating lease portion, especially as flexible operating commitment, more like a high fixed cost that management can dial down if the business needs to shrink rather than absolute liability. Practical way, look at the contractual lease payment only in the next 4 to 5 years instead of the full gap present value. Use EBITDA and rent, and then apply multiple to the rent expense. For factoring Kohl's track record, they've already demonstrated the ability to exit stores and reduce the footprint without catastrophic damage. In short, capitalization is exactly the counter treatment of Burry Gill dislike because it raises the real world optionality you correctly pointed out. That means the headline lease liability number overstates the inescapable burden, and the company's own adjusted disclosures of store closure history back that up. Kohl's leverage looks meaningfully lighter than the raw gap number suggested. That's the core of the can be worked around argument you and they are making. Okay. Alright, you tell me, then let's see if it will tell us. See how intelligent it is. So what would the inescapable debt level actually be if for Kohl's, if we treated it as Burry and Gill would? Let's see, just interesting here. It saves me doing the work, but I better go to sleep, man. I gotta get up in a bit. Got midnight, I didn't realise that. See what this answer is, and then I'll leave it there. Maybe we'll come back to it, depending on this answer. 2.3 billion is contractual. So where has he got 2.3 billion from? Inescapable operations. Come on. Tell me your answer and tell me your reasoning. Under the Burry-Gill lens, inescapable rather than gap collected, Kohl's inescapable debt is dramatically lower than the raw gap suggests. Short-term contract, non-cancelable payments count as real debt-like obligations. The rest can be worked around. Okay, traditional debt 1.4 billion, which we've seen. Gap lease liabilities 5, 2.4 and 2.7. Gap lease term contractual only 4 years on average. The inescapable portion. Kohl's own Q4 2025 earnings presentation explicitly calls out the adjustment that matches exactly what Burry and Gill advocate. The lease payment for periods actually exercised 2.3 billion, which averages 4 years. So what we're saying, there's only 3.7 billion in debt. Yeah. This 2.3 billion is a contractual lease obligation Kohl's uses internally when it calculates this adjusted leverage. Where would I find that in here then? This is the figure they would use for total debt. That's still like 2 billion lower, isn't it? Which means you'd have to state enterprise value down by 2 billion, so it'd be more like 5 billion. Let's just have a look. So that'd be 5 times multiple. That's simple free cash flow to EV. Would it? No, hang on, because 1.2 doesn't meaningfully change it, does it? I mean, it does. It pulls it more into my repayment in 3 years. 2.3 billion covers only rents Kohl legally locked into for the next few years. Everything after that consists of renewal options that are not contractually required. Bottom line, if you analyse Kohl's way, Burry and Gill prefer its true and escapable obligations sit at roughly 3.7 billion. Interesting to know, isn't it? Just be interesting to find where they've got that figure from. You know? Next 4 years. Is it here? No, because that's free. What did they say? 2 point... Maybe this. Well, let's have a look. I've got a calculator out here. 4 years, they're saying. 452 plus 451 plus 443 plus 439 plus 433. 2.2 billion. Let's just ask, where in their statement they stated this 2.7 billion? No, 2.3 billion. It would just be nice to know how they've come to that conclusion, you know? Because it does make a big difference to the debt and the figures. He stated directly in Kohl's official Q4 in his presentation. You can download the PDF. Is that location? Slide 10. Oh, in the presentation. Okay, not in the document then. Not in the actual 10K. Q4 earnings presentation, slide 10. Let's have a look quickly, and then I can go to bed. Slide 10. Here we go. This lease payment for periods actually exercised 2.3 billion, which averages 4 years. When adjusting for its actual lease, so okay. Adjusted leverage. Balance sheet lease liability 5.2 currently reflects the lease periods from all exercise, which averages 18 years. The lease payments for periods actually exercises 2.3, which averages 4 years. Adjusted. Net debt plus leases. $3.1 billion. What did Grok say? 3.7. Yeah, so why have they got 3.1? I don't know. Maybe I'll go a bit deeper on this. Okay. That's interesting though, isn't it? We've learned a bit there. Debt looks materially higher than what it was. No insider buyers though, which fucks me off. Nobody's really very big on it either, which doesn't give me a lot of confidence. Hestia were in GameStop though, when all that went down, along with Roaring Kitty, Keith Gill, and Michael Burry as well. They shrunk their position, but they've obviously bought it at a lower estimated average price 16. What's lower than that now? Depends on the filing date though, I suppose. That would suggest they've made a profit if they sold and it's still a bigger portion. Anyway, I'll leave it there. Thank you very much. Please like and subscribe, and I will see you on the next one. Right, good night.